On October 29, 1929, the United States experienced the worst financial catastrophe in its history. In a single day known as Black Tuesday, the stock market lost over 12% of its value. More than 16 million shares changed hands in frenzied panic selling. Outside Wall Street, crowds of desperate investors gathered. Some begged for information about their life savings. Others contemplated suicide. This was not just a bad day on the stock market. It was the trigger event that would plunge the entire world into the Great Depression, leaving millions homeless, unemployed, and destitute for an entire decade. But how did America, a nation at the height of its prosperity, fall so catastrophically in a matter of hours? To understand this, we must travel back to the 1920s, a decade that would become known as the Roaring Twenties, where ordinary Americans believed they had discovered the secret to unlimited wealth. The 1920s were a time of unprecedented economic optimism in America. After World War I, the nation emerged as a global superpower. Technology was advancing at an astonishing pace. The automobile, the radio, the telephone. These innovations transformed American life. Factories hummed day and night, producing consumer goods at record levels. Unemployment was low, wages were rising. The wealthy were getting wealthier than ever before, and for the first time, average Americans, factory workers, shop clerks, even domestic servants believed they too could join the ranks of the rich. The vehicle for this dream was the stock market. For centuries, stock market investing had been the domain of the wealthy and the well-connected. You needed substantial capital to buy stocks. You needed access to the inner circles of banking and brokerage houses. But in the 1920s, all of that changed. New technologies in communication and transportation made it possible for people in small towns across America to buy stocks with just a trip to a local brokerage office. Stock tickers, electrical machines that printed out stock prices in real time, could now be found in nearly every town and city. Radio broadcasts reported market news instantly. Newspapers published stock prices and financial commentary. For the first time in American history, ordinary people could follow the stock market closely and participate in it. Wall Street bankers and stockbrokers, seeing an enormous business opportunity, aggressively promoted stock investing to the masses. Advertisements promised that investing was easy, safe, and guaranteed to make you rich. Stories of ordinary people who had invested a few dollars and became millionaires circulated widely. A shoe shiner in New York was said to have made a fortune in the market. A taxi driver supposedly turned $500 into $50,000. These stories, some true and many exaggerated, created a fever of investment enthusiasm. Everyone wanted a piece of the action. And this is where the most dangerous financial instrument of the 1920s comes into play. It is called margin buying. Margin buying sounds complicated, but the concept is simple. Instead of saving up your money to buy a stock at its full price, you could pay just a small fraction, typically 10%, and borrow the rest from your stockbroker. So if you wanted to buy 100 shares of a stock at $100 per share, costing $10,000 total, you only needed $1,000 of your own money. The broker lent you the other $9,000. Your plan was to sell the stock in a few weeks or months at a higher price, pocket your profits, and pay back the broker's loan. This system worked beautifully in a rising market. From 1921 to 1929, the stock market rose almost continuously. The Dow Jones Industrial Average surged fourfold. Investors who bought on margin in 1921 saw their investments multiply by 4 or 5 times. For every dollar you invested, you could make $4 in profit. It seemed like free money. Why would not everyone take advantage of this opportunity? By 1929, margin buying had exploded. Brokers were lending staggering amounts of money. At the peak, over $8.5 billion in margin loans were outstanding. This was a sum greater than the entire amount of currency physically circulating in the United States at the time. Think about that figure for a moment. There was more money loaned out on margin than there was actual physical money in the country. This should have been a screaming warning sign, but instead, brokers and investors saw it as proof of the endless opportunities ahead. But here is the fatal flaw in this system. Margin buying works only as long as stock prices keep rising. The moment prices start to fall, the entire structure crumbles. If you bought $10,000 worth of stock with only $1,000 of your own money and the stock price drops by just 10% to $9,000, you have lost all of your initial investment. And the broker will not simply accept that loss. When your stock declines, the broker makes what is called a margin call. This is a demand that you immediately post additional cash to maintain your collateral. You now have to come up with even more money to cover your losses. If you cannot pay, the broker sells your stock, realizing your loss and leaving you with nothing. This created a catastrophic feedback loop waiting to happen. When prices fell, margin calls would force investors to sell. Massive selling would drive prices down further. Lower prices would trigger more margin calls, forcing more selling, driving prices down even more. Mathematically, once this process started, it would be nearly impossible to stop. There were clear warning signs that the market had become dangerously disconnected from reality. In March 1929, 7 months before the crash, the stock market experienced a minor panic. The Federal Reserve had warned that speculation was getting out of hand and needed to be reined in. For a few days, stock prices fell sharply. Investors panicked and sold heavily. But then, almost as quickly as it started, major bankers and financial leaders stepped in and bought stocks, reassuring the market that everything was fine. Prices recovered. This false reassurance only encouraged more speculation. Economist Irving Fisher, one of the most respected financial minds in America, made a famous and fatally wrong statement in September 1929. He proclaimed that stock prices had reached a permanently high plateau. In other words, they would keep rising forever. Fisher was not some fringe figure. He was considered one of the greatest economists of his generation. If Irving Fisher said it was safe, average investors felt validated in their decisions to buy more stocks. But not everyone was convinced. On September 5, 1929, a well-known financial analyst named Roger Babson made a shocking public statement. He predicted that a crash was coming, and it may be terrific. Babson noted that the market was fundamentally disconnected from the underlying health of American businesses. Stock prices had become based not on what companies were actually worth, but on speculation about what they might be worth. The average price-to-earnings ratio of stocks had reached 32.6, far above the historical norm. Companies like RCA, a radio manufacturer, had a stock price that made no sense relative to its actual profitability, yet Babson was largely dismissed or mocked. Market participants were so convinced of continued gains that they could not accept the warnings. There were simply too many people making money from the rising market. Brokers earned commissions on every trade. Financial newspapers and magazines sold more copies when markets were booming. Bankers were lending money, and earning interest on margin loans. Everyone profited from higher stock prices, and no one wanted the party to end. Throughout the summer and early fall of 1929, other economic cracks began to appear. Car sales were slowing. Steel production was declining. There had been a mild recession in the summer of 1929 itself. Consumer debt was reaching dangerous levels. Farmers were struggling. Banks that had invested heavily in real estate were facing mounting losses. But these warning signs were either ignored or interpreted as temporary setbacks that would soon be overcome. The fundamental problem was that American society, after 8 years of booming prosperity, simply could not imagine that disaster was possible. President Calvin Coolidge had repeatedly assured Americans that the economy was fundamentally sound. His successor, Herbert Hoover, elected in 1928, also promised continued prosperity. Business leaders spoke confidently of a new era where the traditional business cycle of boom and bust had been conquered. Economists confidently declared that depressions were things of the past. This overwhelming optimism was perhaps the most dangerous factor of all. Behind the cheerful headlines and rising stock prices, serious structural problems plagued the American economy. First, there was massive overproduction. American factories had been producing automobiles, farm equipment, textiles, and consumer goods at record rates. But consumer demand, while growing, could not keep pace with supply. Inventories piled up. Companies began cutting production. With production cuts came reduced employment. Second, there was a shocking inequality of wealth. While factories hummed and companies posted record profits, workers' wages had barely increased since the early 1920s. Real purchasing power for ordinary Americans was actually stagnant or declining. The wealthy had captured nearly all the gains from economic growth. The richest 1% of Americans owned about 35% of all wealth, while the bottom 50% owned just 2.5%. This meant that demand from ordinary consumers, which should have driven economic growth, was constrained. People simply did not have money to buy all the goods factories were producing. Third, there was rampant speculation in real estate. The Florida land boom of the 1920s is a perfect example. Real estate developers marketed Florida as a tropical paradise. Speculators bought land they had never seen, with money they did not have, expecting to resell it for enormous profits in a few weeks or months. When the Florida bubble burst, as bubbles always do, it left thousands of investors financially devastated. This should have been a cautionary tale about the dangers of speculation, but instead, the market simply moved the speculation from real estate to stocks. Fourth, the Federal Reserve had made serious policy errors. In August 1929, trying to cool down what they recognized as excessive speculation, the Fed raised interest rates. This contractionary monetary policy, while intended to slow stock market inflation, instead contributed to slowing the entire economy and tightened credit conditions. Finally, there was a regulatory vacuum. The stock market in 1929 was almost entirely unregulated. There were no circuit breakers, no trading halts, no mechanisms to prevent panic selling. There were no margin requirements set by federal authorities. Brokers were free to lend as much or as little as they wanted. There was no deposit insurance. If a bank failed, you lost all your money. There were no disclosure requirements. Companies did not have to reveal their financial information honestly to investors. Fraud was rampant and essentially unpunished. This environment of minimal oversight meant that when problems emerged, there was nothing to slow them down. The stock market reached its absolute peak in early September 1929. After 8 years of almost uninterrupted gains, the Dow Jones Industrial Average had climbed to 381. This level seemed to verify the economists' predictions of an eternal bull market. But something changed in September. The market reached its peak on September 3rd, 1929. On that very day, it began a decline that would not reverse for 3 years. The decline was gradual at first. Prices fell a few percent, then rose slightly, then fell again. Professional investors, those with institutional knowledge of how markets actually worked, began to realize the truth. The market had become completely disconnected from economic reality. Stock prices had risen to levels that could not possibly be justified by company earnings or economic fundamentals. Sophisticated investors quietly began to sell their holdings, taking their profits. This selling pressure began to accumulate. September 5th was the crucial moment. That day, financial analyst Roger Babson's prediction of a crash was widely published and discussed in newspapers and financial publications. The fact that a respected analyst was willing to publicly warn of catastrophe suddenly made people question their assumptions. If someone this prominent believed a crash was coming, maybe it was possible. Maybe the market was not infinitely rising after all. If experienced investors started selling, perhaps the wise move was to sell as well, before prices fell further. The selling in September gathered momentum. Stock prices fell 10% over the month. This might not sound dramatic, but it was enough to trigger the first wave of margin calls. Investors who had bought on margin saw the equity in their positions evaporating. They faced a choice: put up new money to cover their margin calls or sell their stocks to limit their losses. Many chose to sell. Yet the market did not crash in September. Instead, prices stabilized in early October. In fact, this brief recovery would prove to be a false signal, a dead cat bounce as traders call it, that lured in a new wave of buyers just before the final collapse. October 24th, 1929, became known as Black Thursday. It was the first truly catastrophic trading day in the crash sequence. Trading opened with massive selling pressure. Investors who had been ignoring the September decline and the warning signs suddenly panicked. The headlines and water cooler conversations had finally convinced them. If prices were falling, they should sell before they fell further. This logic, while seeming sensible to individual investors, created a collective disaster. The sell orders came in so fast and in such volume that the system struggled to handle them. The ticker machines that printed out stock prices in real time could not keep up. By the middle of the day, the ticker was running at least an hour behind the actual trading. Investors were making buying and selling decisions based on outdated prices from an hour ago or more. This meant they were essentially operating blind, making financial decisions without accurate information. At one point during Black Thursday, the ticker machines fell so far behind that certain stocks completely lost their bid prices. Traders were literally trying to sell stocks, but there were no buyers at any price. The stocks had become worthless, at least temporarily, simply because there were no buyers. This is financial panic in its purest form. By lunchtime on Black Thursday, stock prices had fallen over 11% since the opening bell. Over 13 million shares changed hands, a record that seemed almost incomprehensible at the time. The bankers and business leaders who had stepped in during the March panic to restore confidence scrambled to do the same thing again. They believed that if they could simply show confidence by purchasing stocks, they could calm the panic. The key player was Richard Whitney, a prominent banker with ties to J.P. Morgan and Company and the vice president of the New York Stock Exchange. Whitney began purchasing large blocks of the most important stocks at prices above the current market rate. He bought 25,000 shares of U.S. Steel at $205 per share, well above what they were trading for at the time. This bold action was meant to send a signal. The smart money believed stocks were good value at current prices and was aggressively buying. If the titans of finance were buying, the theory went, why should ordinary investors be selling? The tactic worked. The massive purchases by the bankers provided enough buying pressure to slow the decline. By the end of Black Thursday, the market closed down about 2%, not the catastrophic 11% decline it might have been. Newspaper headlines the next day trumpeted crisis surmounted and market stabilizes. Many investors breathed a sigh of relief. They believed once again that the worst had passed. Over the next few days, October 25th, 26th, and 27th, stock prices actually recovered modestly. The selling pressure eased. Investors who had panicked on Black Thursday began to feel like they had overreacted. Analysts began issuing optimistic statements about the market's resilience and fundamentals. Brokers contacted their clients and urged them to hold their positions or even buy the dip. If you were going to sell, you wanted to do it before prices fell, the thinking went. But if prices were rising, was not that a sign to buy? Some investors who had intended to sell on Thursday decided to hold. Others went back into the market to buy, figuring the worst had passed. This is a common pattern in financial panics. After the initial shock, there is often a brief recovery that gives people false hope. Psychologically, people want to believe the crisis is over. Optimism, which had dominated the market psychology for 8 years, dies hard. But this recovery was a mirage. Behind the scenes, the margin calls were intensifying. Brokers, seeing that stock prices had stabilized, figured it was safe to issue margin calls they had been holding during the panic. Banks issued urgent demands for payment. Investors who could not pay, and most could not, faced liquidation of their holdings by their brokers. Over the weekend, before the market opened on Monday, October 28th, banks began issuing waves of margin calls, demanding immediate payment. Investors faced the stark reality. They had to come up with cash immediately, or their positions would be sold, whether they liked it or not. October 29th, 1929, Black Tuesday, dawned on a nation that suddenly understood the severity of what was happening. Overnight, the psychological mood had shifted from the worst has passed to everything is going to collapse. When the stock exchange opened on Tuesday morning, there was a tsunami of sell orders waiting. Investors and brokers who had received margin calls over the weekend were desperate to dump their stocks before prices fell further. The opening bell rang and the selling began immediately. Unlike Black Thursday, where at least there were pauses and some stability, Black Tuesday was an unrelenting avalanche of sell orders from the first second. There were no pauses. There was no recovery. There was just selling and more selling. The ticker machines, which had been upgraded after Black Thursday to handle higher volumes, still could not cope with the volume of trading. The system became completely overwhelmed. Transactions that occurred at 10 a.m. were not printed on the ticker until 3 p.m. By the time a stock price appeared on a ticker machine, it was completely outdated. The actual market price might have moved 50% in either direction. Desperate brokers began using Western Union messengers, literally taxi drivers and runners, to carry handwritten messages between the stock exchange and their offices, trying to communicate prices faster than the official ticker. It was a scene from another era, using 19th century methods, because 20th century technology had proven insufficient for the disaster. By mid-morning, as the scale of the selling became clear, all pretense of order collapsed. Panic spread through the financial district like wildfire. Crowds of desperate investors gathered outside the stock exchange on Wall Street. Police and security guards struggled to maintain order. Some investors wept openly. Others simply stood there, apparently in shock, contemplating the destruction of their life savings. The trading records for the day show the utter chaos. 16 million shares were traded, a record that would not be broken for decades. In a single day, the volume was equal to 10% of all stocks outstanding in the entire market. The Dow Jones Industrial Average fell 12% in one day, a decline of about 90 points from where it started. But the summary statistics do not capture the chaos. Certain individual stocks fell 20, 30, even 40% in a single day. The ticker machines fell further and further behind, so traders were constantly operating on outdated information. Margin calls were being issued faster than people could deal with them. By the closing bell at 3 p.m., the stock exchange was utterly devastated. Richard Whitney and the bankers who had heroically bought stocks on Black Thursday 4 days earlier were nowhere to be found. The magic of their intervention had evaporated. There were simply too many sellers and too few buyers. The bankers had insufficient capital to stem the tide. In the days and weeks following Black Tuesday, the carnage continued. Instead of stopping, the selling accelerated. Stock prices fell another 80% over the next 3 years. Billions of dollars of wealth that had seemed real and concrete just weeks before, simply vanished. Investors who had margin calls could not pay them. Brokers liquidated positions, realizing catastrophic losses. Banks that had loaned out margin money suddenly found themselves holding massive bad debts. Brokers went bankrupt. Banks failed. The financial system itself began to seize up. Consider the human cost. A man who had saved for 40 years and seen his modest savings grow to $100,000 through careful stock investing in 1929 found himself bankrupt by 1932. A widow living on stock dividends from her late husband's insurance money found those dividends stopped as the companies cut payouts. A young couple who had borrowed money to invest on margin, expecting their nest egg to grow for their retirement, found themselves not just bankrupt, but deeply in debt. The stock market crash was not an isolated event. It was a symptom of deeper economic problems, and it triggered a cascade of disasters. With the market in free fall, consumer confidence evaporated. People stopped buying. Companies that could not sell their products stopped hiring and began laying off workers. Unemployment rose from 3% to 25% over the next few years. As unemployment rose, fewer people could pay their mortgages or rent. Banks and lending companies suffered cascading defaults. More banks failed. More businesses failed. More people lost their jobs. The Great Depression that followed was the worst economic catastrophe in American history. Millions of Americans became homeless, living in shanty towns called Hoovervilles, named mockingly after President Herbert Hoover. Children went hungry. Farmers lost their land. The federal government, unprepared for such a catastrophe and hamstrung by outdated economic ideology, struggled to respond effectively. The Depression lasted for an entire decade until World War II finally provided enough government spending and job creation to revive the economy. In retrospect, the 1929 crash and the Depression that followed were not inevitable. They were the result of specific policy mistakes, regulatory failures, and rampant speculation enabled by inadequate oversight. The Federal Reserve's contractionary policy in 1929 was a mistake. The complete lack of margin regulation was a mistake. The lack of circuit breakers or trading halts was a mistake. The absence of deposit insurance and corporate transparency requirements was a mistake. The speculative bubble itself, enabled by margin buying and aggressive marketing of stocks to unsophisticated investors, was a mistake. But perhaps the biggest mistake was psychological. Investors and policymakers fell victim to the conviction that the normal rules did not apply, that we had entered a new era where the old laws of economics no longer held. They believed that this time was different, that stock prices could rise forever, that we had conquered the business cycle. This conviction, that traditional economic constraints no longer apply, is perhaps the most dangerous belief that can take hold in financial markets. The lessons from 1929 have been partially learned. Modern stock exchanges have circuit breakers that halt trading when prices fall too rapidly. The Federal Reserve has tools to inject liquidity into financial systems during crises. Margin requirements are now set and enforced by federal authorities. Securities are regulated and fraud is prosecuted. Deposit insurance protects bank customers. Corporate disclosure requirements help prevent fraud. Yet human nature remains unchanged. Speculation periodically returns to markets. Bubbles have formed and burst repeatedly since 1929. The conglomerate bubble of the 1960s, the real estate bubble of the 2000s, the dot-com bubble of the 1990s, the cryptocurrency bubble of recent years. Each time, people convince themselves that this time is different, and each time, the bubble eventually bursts, harming millions of ordinary people who believed the optimistic narratives. The Black Tuesday crash of 1929 stands as a permanent reminder of what can happen when speculation, inadequate regulation, and mass psychology combine. It is a warning from history that remains as relevant today as it was nearly a century ago. The crash that destroyed fortunes and triggered a depression lasted only a few hours of trading, yet its consequences shaped the entire world for the next decade. This is the power of financial markets and the importance of maintaining safeguards against the destructive force of unchecked speculation and panic